Good morning, everyone. First of all, thank Christian and Valuespain for having us here once again. It's always a pleasure to participate. Okay. And can you hear me? Okay. Now, just a brief introduction of Magallanes. We are an pure equity asset manager. We just do equities long only and focus in Europe. We have three main strategies: an European equity that is compounds 85% of our assets, an Iberian strategy, it's roughly 10%, and a microcaps strategy of 5%. In terms of characteristics, what make us different, it's our independence. We are managed and controlled by our founders, and it's also the co-investment between all the founders of the PMs, and everyone on the team is invested in the funds. In terms of assets under management, we manage roughly 2.4 billion, and we have a long track record managing European and Spanish equities. Here, in terms of the track record, we have seen we have managed to outperform our benchmark, and instead of focusing to the individual years, I would call your attention to the annualized performance, almost 9% a year, net of fees, against less than 5% for the benchmark. So 9% annual return in a very difficult context for Europe and for the European equities. So I think that's noticeable. So let's start with our investment idea. I think the majority of us are big fans of beer or cider. So I'm introducing here something that we are all consumers, and it's CNC Group. I think it's very well known for our UK attendees. And what we think it's interesting, it's the recent de-rating that we believe that offers a very attractive opportunity for long-term investors as ourselves. We're going to detail it in the next couple of slides. First, CNC, it's a vertically integrated premium drinks company. They manufacture, market, and distribute beer and cider, and then they have a distribution arm that is responsible for distribution of beers, cider, wine, spirits, and soft drinks across UK and Ireland. And the company was founded in 1852, so a long track record here as a company. In terms of revenues, the company just today released their trading statement. It's pretty much in line what we were expecting: 1.6 billion of revenues, 117 million EBITDA margin of 7.1%, and a net income of 56 million. In terms of multiples, using these estimates, we believe it's cheap: 7 times EV to EBITDA. Less than 12 times earnings for a market cap of less than 600 million, and the company is an Irish company, but is listed on the UK Stock Exchange. In terms of revenues and operating profit, I think we're going to detail it next, but these two divisions, distribution and the branded business. In terms of geographies, it's the Great Britain, 80% of the revenues. Ireland, it's 19%, and the international business less than 1%, being Spanish. Spain, the biggest market outside their natural markets. In terms of the shareholder structure, as you can see, there is no controlling shareholder. There's a lot of investment funds, and we Magallanes are one of the biggest funds. We hold 3.7% of the company. So as you can see, we have skin in the game. In terms of the business model, there are two divisions. It's the branded division. It's 18% of the revenues, but a more balanced share in terms of the operating profit and they are responsible for producing this cider of beers, Bulmers, Tennants, or Magners. They're well known in the UK and Ireland. This is the legacy businesses. This is where the company started, and then we have the what we would call the new part of the business is the distribution business. It's 82% of the revenues, but it's less in terms of the operating profit. As you know, they have lower margins, this type of businesses. So what happened here? Here you can see the share price evolution of CNC since 2019. First, they were hit hard by the COVID, as you can see, a company where 80% of the profits came from the on-trade business, being the on-trade, pubs, bars, restaurants, hotels. So if we are all locked in at our houses, of course, this has a huge impact on the company. Then we have the cyber attack. When we are coming out of the first wave of COVID, their distribution business had suffered a cyber attack that impacted their operations for a couple of weeks. Then in 2021, we had all these supply chain issues that impacted their activity, and being a UK company, as we all know, that they've suffered for all these tight labor markets, especially in the blue collar part of their workers, especially the drivers, so affected them. At the end of 2021, we have this Omicron variant hitting hard also the UK, another headwind for the company. And then in 2022, we had the war in Ukraine, Russia invading Ukraine, with the impact that we all know that had in the cost structures of all the companies. So you can see that now we have the company trading at the same level that we were in the peak of the COVID, when we were all locked in our houses. And we don't think that this makes sense. There are structural changes in the business model, but most of these effects are temporary effects, and that's what we're going to explore here in the next slides. First, the distribution part is the most consensual part of the business. It's the one that every investor likes. In the last years, they have managed to create the #1 drinks distributor platform in the UK and Ireland, and that they've managed this by doing this transformational deal in 2018, where they acquired Matthew Clark and Bibendum. It was a couple of companies that were owned by a private equity and went into administration. They knew very well the company. They lost the bid to this private equity, and they were able to buy the companies at 155 million valuation. That's less than 5 times EV/EBITDA pre-synergies. So it's a very cheap multiple for this type of businesses. They were already the biggest distributor in the UK, and with this acquisition, CNC Group was able to get 30% market share in the UK. They serve 13,000 outlets of roughly 102,000 outlets in the country. And then in Ireland, they were already present. They work in a duopoly with Heineken distribution arm, and they both have roughly 40% of the market, being CNC the leader. What have they done since the beginning? They have started this One CNC project. They have unified the management team. They have unified their own network, and what they provide to the brands is the access to the market at a very low cost, and they bring access to the lowest, or the best, or the biggest network distribution in the UK and Ireland. In terms of their revenues, in terms of the margin, they have the 2 avenues of growth. It's win more customers, and then to increase the share of wallet of each customer. And in terms of the transformation they are doing, digitalization, they are investing a lot in online ordering, and 63% of their orders are already done online, and they have a target of doing it to reach to 100%. In the past, oh sorry, they had a 3% operating margin target, and last year they increased this target to 4%. We believe they will end the 2023 fiscal year, and their fiscal year is ending February 23. So the results they will present now in May. It should be very close to already this target of 4% operating margin. But we believe there's opportunities here in the distribution. As you can see, they have the biggest last mile distribution in UK, with a deep capillarity across all the countries, across all the regions. In terms of the competitive landscape, you can see how the market is organized. There's several characteristics that you have to own, and that to be a very good logistic company. And if you can see, they are the one that tick all the boxes. They are the ones that are present in all the characteristics that you need for a good business. And in terms of competitive landscape, I would call the attention for competitors A. That's a long-term target for them, for an avenue of growth. This is the third-party logistics, is the one like DHL's trade team in the UK, or XPO, where they do the business for the Carlsberg, for the Heineken, and this is mainly a beer distribution business. But of course, these are very big, very long-term contracts that started many years ago, so they are losing money. Both companies would love to get out of these contracts. So whenever you order a pint in the UK, you have to thank the DHL that is subsidizing your pint. And that's an avenue. If these countries, when these contracts come to market again with different characteristics, with different profitability, I think that will be a very good opportunity for CNC to grow. But in the short term, we believe that the biggest opportunity lies in competitors D. This is, for instance, LWC Drinks. It's a small Matthew Clark Bibendum. It's a company that is suffering a lot of problems for the last quarter. So if the uncertainty continues, we wouldn't be surprised to see that CNC buys this company. And the other company here, it's in Austria. It's a company more focused on the wines and spirits distribution. It's also suffering from competitive. They have huge leverage, so we believe this company could be a target. And CNC is going to be the biggest consolidator of the UK distribution market. Now coming to the brands. So the three biggest brands are the three profit engines from the company. They represent 80% of the revenues, even more in terms of the operating profit. Then they have an agreement, a distribution agreement with AB InBev, so they have the exclusivity for the distribution of these brands in Ireland, and non-exclusivity in the UK. And on the other end, they have AB InBev distributes the Magners brand in the UK. And then we have all these new trends about premium craft or agency brands, with a target of 10% of the revenues in the midterm. Now they represent roughly 4%. Just a brief overview of the main trends in the UK and Ireland in beer. In terms of cider, it's not different from what the trends we are seeing in all the developed markets. So in terms of volumes, we see the alcohol consumption per capita coming down roughly 1-2% every year. We are in what's called the age of wellness, so people are more aware of their health. But this is more than compensated by the pricing, the regulation, and the premium trends. So you can see people drink less beer, drink less cider, but that's compensated with premium price increases and regulation. Also, since COVID, we see off-trade gaining market share to on-trade, so people drink more at their homes. cider losing a little bit of market share against beer. And we have all, in terms of premium, you can see that CNC can compensate this. They have already 4% market share in the UK and Ireland in terms of the premium beers. And then we have these new trends of new products, new flavors that's gaining a lot of traction, and they are already prepared. They invest a lot in innovation. So we have Bulmers Light, Bulmers Zero, Bulmers Rosé, or the fruit flavored Bulmers. These are their three biggest brands. So Bulmers is the number one cider brand in Ireland. They have the market leaders in both channels with more than 58% of market share. Today they announced they continue to gain market share, so they should be roughly at 60%. Then we have Tennant's. It's the number one beer in Scotland, 29% market share. It was founded in 1885. And they also announced this morning they continue to gain market share, so they should be roughly at 30% market share in Scotland. And then we have Magners. It's the number 3 cider brand in the UK, and it's the international brand sold in more than 40 countries. Here you can see that this is Bulmers in Ireland. You can see they continue to gain market share in all the channels. In terms of Magners in the UK, they continue to gain market share, and this is a data point that we really like, that 1 in each 5 drinks in the Great Britain, in Ireland, it's a drink from CNC. So you can see they really have a strong market share, a strong position, a strong brand in the countries. So what has been affecting CNC margins? First of all, we have the wage inflation. They had to increase wages around 5%. Wages represent roughly 8% of their cost base. And then we had this manufacturing input cost, that the one that's more vulnerable to the subsequent events of what happened in Russia and Ukraine. This represents roughly 10% of their manufacturing cost, but went up expressively. For instance, in 2023, so until February 2023, they had a guidance of an increase of 25%. And it's not even more because they have the hedges, but of course hedges will roll off. So for 2024, they are expecting another 20% price increase on their cost base, in their manufacturing cost base. For 2025, this should be a tailwind. We are already seeing some of the costs rolling over, like electricity, like gas. But we had others like the malt, the glasses, or the apples, where prices continue to go up, but it continue to be quite ahead of the pre-Russian invasion. This is partially offset with price increases. They are price followers. They can only follow what Heineken and Carlsberg do in their main markets, so they are increasing prices 8-9% a year, and that's offsetting. All this, we believe it's a temporary effect. We don't believe this is a structural impact, and they will be offset with prices, because everyone, even the big multinationals, suffer this input cost inflation and have to translate this to higher prices. And in a couple of years' time, we believe that should start to normalize and even to be a tailwind for the company. And then what we think it's a more structural effect, it's the marketing investment. We believe that the company, and the company recognizes this, they were under-investing in their brands, so they were investing average of sales less than 7% between 2018 and 2022, and they had to step up this investment. In the first half of 2023, they were investing already 11%, and we believe this will trend up until 12% in fiscal year 26, so until February 26. Also, this really should be offset by stronger organic growth. So here, in terms of what's happening to the company margins, you can see first in green in the branded business part of the business, they had margins that were north of 25%, so very high margins. 2021 is, of course, the impact of COVID, and we believe that market margins should start to normalize. In the branded business, they will end up fiscal year 23 with roughly between 12 and 30% EBIT margins, and should trend up to 15%. That's more or less what the big multinationals like Carlsberg and Heineken have in these kind of businesses. And in the case of the distribution, they should end up around 3.6, 3.8% distribution margin for the company. So, and we believe this will trend up until 4% in the next couple of years. So pre-COVID, the company was generating 7% EBIT margins, and we believe that the company will now generate 6% margins in a couple of years' time. In terms of balance sheet, the company has a very strong balance sheet. It's a very strong cash flow generative business model. So they'll end it this year at 1.3 times net debt to EBITDA, well below the 2 times net debt to EBITDA target of the company. So they have firepower for M&A, and they don't have any refinancing needs until 2030 and 2032. They were lucky. They just before the COVID broke up, they had 2 major private placements at a fixed cost of 1.6 to 2.74. So we believe that's very cheap. And today they announced the results. The free cash flow generation, excluding the asset sales, was 100 million euros. So that's 90 million pounds for a company that is 600 million market cap. So we're talking about free cash flow to the equity of 15%. We think is very attractive, and we believe this could be the normalized free cash flow generation of the company. So in terms of valuation, we have 3 scenarios. Our base case, where they recover the pre-COVID sales until 2026. This is not huge. They are 4% below the pre-COVID sales. The branded margin will go to 15% versus the more than 25 they had, and the distribution stays at 4%. In the best case, if they return the profitability, we'll have a price target of £4. And the current scenario, if there is no improvement in terms of profitability, in terms of distribution margin or the branded, the results they presented last year, we would still have an upside. So the risk return is quite attractive. In terms of the risks, of course, the macro environment in UK and Ireland, changing customer dynamics, regulation, competitive environment, of course, and cost inflation and FX. But we believe the majority of these risks are already priced in, and that justifies the current valuation of the company. And just to to wrap up, we find it attractive valuation: 0.4 EV to sales, 5.5 normalized EBITDA, and 14% free cash flow yield. It's an exposure to the profitability recovery of the branded business. It will be the consolidator of the market. We will have organic growth. They have a very good and experienced management team, and we have opened the door. Today they announced they will reinstate the dividend, and we believe that in May they could announce a buyback of up to 5% of their market cap, and given the strong balance sheet and the icing of the cake, they could be an M&A target. They have this joint venture or partnership with AB InBev. In the past, there was rumors about M&A. We believe AB InBev has bigger problems in terms of priorities, but in a couple of years' time, we believe this could surface again. So thank you very much.
Thank you. Any question? Anybody? Any question about cider, beer? So hungry? It's amazing. Yeah, you have a.
Given that drinking in the UK has recovered post-COVID, why haven't they recovered yet in terms of their share price?
Yeah, because I think if I go here, let me. Yeah, in the UK, the market has already recovered here in terms. in terms of share price, here they are, in terms of pre-COVID sales, they are 4% below their pre-COVID sales, but in terms of operating profit, they are 31% below their operating profit. So the biggest pushback is this profitability will never recover. But we believe that's very harsh, it's very extreme, given that we believe that these are temporary effects, especially what relates to cost inflation.
Hi, thanks. In the distribution business, apart from the low, well, relatively low operating margins, what are the returns like? Because isn't it quite do you need a lot of assets to cover all those 20,000, whatever, clients? Do they have to do any, well, delivery, the stock holding, whatever? So what are the returns of the business like?
Yeah, the returns are very, very high because it's an asset-light business model, so they have everything in terms of leasing, in terms of it's fast-moving consumer goods. So in terms of inventory, their inventory is around 160 million. So that's roughly 10% of their sales, and it should not be an issue. In COVID, they didn't have any inventory write-downs, so we don't believe that's an issue. They have a 4% operating margin, and they believe they could go up to 4.5%, but they believe if they go up to 4.5%, that will give oxygen to their struggling partners. So they want to be they want to have a wealthy growth, and at the same time to put pressure on some of these smaller guys that I believe and they believe should disappear in the next quarters, and they are the best position to acquire these companies.
Thank you.
Hi, thank you. I'm wondering on the Brandon side, is there a difference in profitability in Scotland versus England? Because where they have this dominant position, not in Scotland, in Ireland versus England, where they have this dominant position of 58% market share in Ireland, but they're the third biggest brand in England. I'm just wondering what that means for profitability.
Yeah, they don't disclose that profitability with the discussions that we had with them. There's a profitability gap, but that comes from where they sell. In the Magners in Great Britain, they sell mainly through supermarkets. They're more exposed to the off trade, so they have to negotiate with the Tesco's and the Sainsbury in the world. So that's more difficult to negotiate. So we estimate that they have 7-8% operating margins in the UK in the Magners business against more than 20% in tenants in Scotland. But for instance, in Bulmers in Ireland, they have more than 32% operating margins there, because there they operate mainly in the on-trade segment.
Thank you. What is your assessment of management and especially how they reacted to all the hardships that came their way?
They have a new management team that's very experienced. The CEO started late 2020, but he's a guy that was more than 20 years working for Heineken and is now the CEO. The CFO was for the last 15 years in the company, so he knows the company, understands very well the company. And the chairman that also started in late 2020 was the previous CEO of Marston's, so the biggest pub company group in the UK. So between the two of them, they really understand the business. I think in terms of the way of doing things differently, I would say that the new CEO comes from a multinational, that these guys are used to invest in their brands, to spend more in marketing, and that's why his decision to invest more in marketing, to increase their marketing spend in the next years, to go in line with their competitors.
Okay. Thank you very much, Diogo.
Thank you.